Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, and the content in this video should not be considered financial, legal, or tax advice. Securing a mortgage is a significant financial decision, and you should always consult with a qualified and licensed professional to discuss your individual situation before making any choices. Imagine two people, let's call them Sarah and David. They live in the same town, they're looking to buy their first home, and they both get pre-approved for a $400,000 loan. They have nearly identical credit scores, similar incomes, and the same down payment. They even end up buying houses on the same street for the exact same price. But here's where their stories completely diverge. David locks in a mortgage rate of 6%. Sarah, who signed her paperwork just a few weeks later, gets a rate of 7%. 1%. It sounds like nothing, right? A tiny, insignificant number. But that 1% difference means Sarah is paying an extra $268 every single month. That's over $3,200 a year. Over the 30-year life of the loan, that single percentage point will cost Sarah an astonishing $96,752. Think about that. Nearly $100,000. That's a luxury car. That's a full college fund for a child. That's the difference between retiring comfortably and working an extra 5 years. And it all came down to a single number that, for most people, feels completely random and out of their control. A number that a lender slides across the desk and says, "This is the rate." We treat mortgage rates like the weather. We check them, we complain about them, but we feel powerless to do anything but accept them. But they are not the weather. They are not random. There is a system. There are specific identifiable forces that push that number up or pull it down. And for the next few minutes, we are going to pull back the curtain on that entire system. We're going to decode the mystery. By the end of this, you will understand the invisible architecture that controls the single most important number in your financial life. You will understand what the talking heads on the news actually mean when they talk about the economy, and you'll be able to see the signs of rate changes coming long before they happen. This isn't just about getting a better rate. It's about taking back control over your financial future. So where does this all begin? To understand mortgage rates, you first have to understand the biggest player in the game, the one that sets the entire tone for the US economy. I'm talking about the Federal Reserve, or as you usually hear it called, the Federal. Think of the US economy as a giant, powerful car. The Fed is the driver. Their foot is constantly hovering between the gas pedal and the brake. Their main job is to keep the car running smoothly. Not too fast, not too slow. If the economy gets too hot, if it's speeding and at risk of overheating, the Fed taps the brakes. If the economy is sluggish and stalling out, the Fed hits the gas to get things moving again. Now, what are these pedals? What is the gas and what is the brake? It's one primary tool, the federal funds rate. This is the master key. The federal funds rate is the interest rate that big banks charge each other for overnight loans to meet their reserve requirements. Sounds complicated, but think of it like this. It's the wholesale cost of money for the banks themselves. When the Fed raises the federal funds rate, it's making the wholesale cost of money more expensive for the banks. And just like when the cost of coffee beans goes up for your local cafe, what do? They raise the price of your latte. When the Fed makes it more expensive for banks to borrow money, banks turn around and make it more expensive for you to borrow money. That means higher rates on credit cards, car loans, and yes, the big one, mortgages. So when you hear on the news, the Fed has decided to raise interest rates by 1/4 point, what they're really saying is that the fundamental cost of borrowing money in the entire United States just went up. Mortgage lenders see this. They know their own cost of doing business is about to increase. So they proactively raise the rates they offer to homebuyers to protect their profit margins. It's a direct ripple effect starting with the Fed, flowing through the banking system, and landing right on your mortgage application. The Fed hits the brakes and your borrowing power slows down. Conversely, if the economy is weak, if people are losing jobs and businesses are struggling, the Fed does the opposite. They hit the gas. They lower the federal funds rate. This makes the wholesale cost of money cheaper for banks. The banks, competing for your business, then lower their rates to entice you to borrow money and spend it. Cheaper car loans, cheaper business loans, and cheaper mortgage rates. The goal is to inject energy into the economy, to encourage spending and investment, and to get that car back up to a healthy speed. But this begs the most important question of all. Why does the Fed hit the gas or the brake? What are they looking at on their dashboard that makes them make these massive economy-altering decisions? The main gauge they are watching, their number one obsession, is inflation. Inflation is simply the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. In plain English, it's the reason a gallon of milk that cost $3 last year costs $3.20 this year. It's that sneaky force that makes your paycheck feel like it's shrinking, even if the dollar amount stays the same. Your $10 just doesn't buy as much as it used to. The Fed has a target for inflation, typically around 2%. They see this as the Goldilocks level. Not too hot, not too cold. It's a sign of a healthy, growing economy. But when inflation starts to climb way past that target, when it gets to 5, 6, 7% or more, alarm bells go off at the Federal. This is the economy overheating. The car is redlining. High inflation is a silent tax on every single American. It erodes savings and makes it harder for families to afford basic necessities. So what does the Fed do? To fight inflation, they have to slow down the economy. And their primary weapon is raising the federal funds rate. They make borrowing money more expensive on purpose. The idea is that if mortgages, car loans, and business loans are more expensive, people and companies will borrow less and spend less. This reduced demand for goods and services will then, in theory, cause prices to cool off and bring inflation back down to that 2% target. It's a blunt instrument and it can be painful. It can lead to slower economic growth and even a recession. But it's the Fed's main tool for putting out the fire of inflation. So the chain of command is simple. High inflation forces the Fed to raise its key interest rate. That rate hike makes it more expensive for banks to operate, so they, in turn, raise the interest rates they offer you on a mortgage. But here's the critical secret that most people miss. The federal funds rate and your mortgage rate are not the same thing. They're related like cousins, but they're not identical twins. The Fed's rate is for overnight loans between banks. Your mortgage is a loan for 30 years. They live in different worlds. The Fed sets the general climate, but it doesn't control the day-to-day weather. That's why you can see the Fed announce a rate hike, and yet mortgage rates might barely budge that day or sometimes even go down. This is because there is another, even more powerful and more immediate factor that directly influences the number on your mortgage contract. It's a factor that operates in real time every single second of the trading day, and it has nothing to do with a meeting in Washington, D.C. It's tied directly to the global bond market, specifically, a little thing called the 10-year Treasury yield. And understanding this one single indicator is the closest you can get to having a crystal ball for where mortgage rates are headed next. So what is this magical number? This 10-year Treasury yield? And why on earth does it dictate the rate you'll pay on your 30-year mortgage? To put it simply, think of the 10-year Treasury yield as the pulse of the entire United States economy. It's the single most watched indicator of investor confidence, not just in America, but around the world. First, let's break down what it actually is. When the US government needs to borrow money to fund everything from highways to the military, it issues bonds. A bond is just a fancy word for an IOU. You give the government money, and they promise to pay you back with interest over a set period. A 10-year Treasury note is simply an IOU from the US government that matures in 10 years. The yield is the effective interest rate that the government is paying on that 10-year IOU. Now, here's the crucial part. This yield isn't set by the government. It's determined by the open market, by the constant buying and selling of these bonds by millions of investors worldwide. It's pure supply and demand. And what drives that supply and demand? One thing: confidence. Or more accurately, fear and greed. Let's imagine two scenarios. Scenario 1. The economy is booming. The stock market is soaring, companies are hiring, and everyone feels optimistic. Investors are feeling greedy. They want high returns. They're pouring their money into stocks, into real estate, into startups. They're chasing growth. In this environment, a safe, steady, but relatively low-paying government bond looks, well, boring. For an investor to be tempted to buy a government bond instead of a hot tech stock, the government has to offer a better deal. It has to offer a higher interest rate, a higher yield. As investors sell their bonds to buy stocks, the price of those bonds goes down, which in a seesaw effect pushes the yield up. So when the economy is strong and confidence is high, the 10-year Treasury yield rises. Now let's flip it. Scenario 2. The economy looks terrifying. The news is filled with talk of recession, layoffs are starting, and the stock market is plummeting. Investors are no longer greedy, they are fearful. They're not trying to get rich, they're trying not to go broke. They pull their money out of risky assets and desperately search for the safest place on planet Earth to park their cash. And what is universally considered the safest investment in the world? U.S. Treasury bonds. They are backed by the full faith and credit of the United States government, which has the power to tax its citizens and print its own currency. They have never ever defaulted. So during a crisis, a massive flight to safety occurs. Everyone wants to buy these bonds. With so much demand, the government doesn't need to offer a high interest rate to attract buyers. The flood of money pushes the price of bonds up, which causes the yield to go down. So, high confidence in the economy equals a high 10-year yield. Low confidence and high fear equals a low 10-year yield. It's the economic barometer. It tells you exactly how the biggest players with the most money are feeling about the future. Okay, that's great, but the million-dollar question remains. What does this have to do with your mortgage? The connection is so direct it's almost mechanical, and it comes down to a simple concept: risk. Imagine you're a giant bank or an investment fund with billions of dollars to lend. You have two basic options. Option A is to lend your money to the U.S. government for 10 years by buying a treasury bond. This is considered the risk-free rate of return. It is the safest investment you can possibly make. Option B is to lend your money to a regular person like you for 30 years so you can buy a house. This is a mortgage. Now, even if you have perfect credit and a stable job, you are still infinitely riskier than the U.S. government. Life happens. People lose jobs, get sick, go through divorces. There is always a chance, however small, that you might not be able to pay the loan back. Because of this extra risk, the lender demands to be compensated. They will always charge you a higher interest rate than the risk-free rate they can get from the government. This extra amount is called the risk premium, or the spread. So the formula for your mortgage rate looks something like this: the 10-year Treasury yield plus a risk premium. This is why, if you look at a chart of the 10-year Treasury yield and the average 30-year fixed mortgage rate over the last 50 years, they look like two dancers moving in almost perfect sync. When the Treasury yield goes up, mortgage rates go up. When the Treasury yield goes down, mortgage rates go down. They don't move by the exact same amount every day, because that risk premium can shrink or grow a little bit depending on other factors in the housing market, but the directional link is undeniable. The Treasury yield is the engine, and the mortgage rate is the caboose. Let's dig one level deeper, because this is where you really start to understand the plumbing of the financial system. Most of the time, the bank that gives you your mortgage doesn't actually keep your loan. They package it up with thousands of other mortgages into a product called a mortgage-backed security, or MBS, and sell it to large institutional investors like pension funds or insurance companies. Now, that big pension fund manager is making the exact same calculation we just talked about. They're looking at their screen and they have a choice. They can either buy a pile of U.S. Treasury bonds and get, say, a 4% yield guaranteed. Or they can buy this MBS, this bundle of mortgages, and get a return from all those homeowners making their monthly payments. For that pension fund to even consider buying the riskier MBS, the yield on it must be higher than the Treasury yield. If the 10-year Treasury yield suddenly jumps from 4% to 4.5%, that pension fund manager is going to demand a higher return from the MBS as well. Otherwise, why take the extra risk? They'll just buy the safer government bond. And how does the MBS offer a higher yield? The only way is by charging a higher interest rate on the new mortgages that are being put into the bundle. That pressure flows directly downstream from the global bond investor through the Wall Street banks, all the way to the loan officer sitting across the desk from you, telling you that rates went up a quarter point this morning. This is not a theory. It's the daily reality of the market. During the panic of the 2020 pandemic, investors fled to safety. The 10-year Treasury yield plummeted to historic lows, below 1%. And what happened to mortgage rates? They followed right behind, dropping to the lowest levels in recorded history, creating a massive refinancing boom. Conversely, in 2022 and 2023, as fear of inflation gripped the market, investors sold off bonds, worried that inflation would erode their returns. The 10-year Treasury yield skyrocketed. And mortgage rates? They went on one of the fastest and most brutal ascents we have ever seen, more than doubling in a little over a year. It wasn't because banks suddenly got greedier. It was because their baseline cost of money, the 10-year Treasury yield, had exploded. So if you want a real-time, forward-looking indicator of where mortgage rates are headed, don't listen to headlines about last month's jobs report. Don't listen to a politician's speech. Open a new tab in your browser and search for 10-year Treasury yield. It is the lead domino. It is the current that pulls the entire market with it. But the 10-year Treasury is only the lead domino. There's another, even more powerful force that can knock it over. A single institution with the power to manipulate this entire system. We're talking, of course, about the Federal Reserve. And what they do with something called the Fed funds rate is the next piece of the puzzle you absolutely need to understand. So what is this Federal Reserve? Is it part of the government? Is it a private bank? The answer is kind of both. And that's by design. The Fed, as it's called, is the central bank of the United States. Think of it as the bank for banks. Its job isn't to give you a checking account or a car loan. Its job is to manage the entire U.S. economy, to keep it stable and growing. It has what's called a dual mandate, a two-part mission statement given to it by Congress. First, to keep prices stable, which really means fighting inflation, and second, to achieve maximum employment. Keep people working and keep the cost of living from spiraling out of control. It's a monumental task, a constant balancing act. To do this, the Fed needs a very, very big lever to pull. A tool powerful enough to speed up or slow down the entire multi-trillion-dollar U.S. economy. That tool is the federal funds rate. Now that name sounds incredibly boring and technical. Federal funds rate. It sounds like something you'd read in a textbook and immediately forget. But I want you to reframe it in your mind. Don't think of it as an interest rate. Think of it as the wholesale price of money. Imagine all the money in the country is like a product. Let's say it's water. You, the consumer, get your water from a retailer like your local water company. But where does that company get its water? It gets it from a massive central reservoir. The federal funds rate is like the price that the reservoir charges the local water companies. It's the base level cost. In the real world, banks are required to hold a certain amount of cash in reserve every single night. Sometimes a bank might be a little short on that cash because they made a lot of loans that day. Other times a bank might have extra cash sitting around. So what do? The bank that's short borrows money overnight from the bank that has extra. The interest rate they charge each other for that overnight loan. That is the federal funds rate. And the Federal Reserve, through its powerful market operations, sets a target for this rate. It's the most fundamental cost in the entire banking system. It's the interest rate for the banks themselves. So how does this overnight bank-to-bank lending rate end up affecting the 30-year mortgage on your dream house? It's a ripple effect, a chain reaction. When the Fed raises its target for the Fed funds rate, it instantly becomes more expensive for banks to borrow money from each other. Their own internal cost of doing business just went up. They're paying more for their raw materials. In this case, money itself. And just like any business, when their costs go up, what do? They pass those costs on to their customers. This increased cost ripples out through every single product a bank offers. The interest rate on your credit card goes up. The rate on a new car loan goes up. The rate on a business loan goes up. And of course, the rate on a mortgage goes up. The bank needs to maintain its profit margin. If it costs them more to get money, it's going to cost you more to borrow that same money. The connection is not one-to-one. A quarter-point hike in the Fed funds rate doesn't automatically mean a quarter-point hike in your mortgage rate the next day. But the direction is almost always the same. The Fed funds rate acts like the tide, and all other interest rates are the boats that rise and fall with it. But this begs the most important question. Why? Why would the Fed intentionally make it more expensive for everyone to borrow money? Why would they purposefully tap the brakes on the economy and make your mortgage more expensive? It goes back to that dual mandate. Specifically, fighting inflation. Picture the economy as a car. When it's booming, everyone's spending, businesses are hiring, and wages are going up. The car is speeding up. But if it goes too fast for too long, the engine starts to overheat. That overheating is inflation. The price of everything, gas, groceries, houses, starts to rise rapidly because there's too much money chasing too few goods. Your paycheck might be bigger, but it doesn't buy as much as it used to. This is dangerous. So the Fed steps in. To cool the engine down, they press the brake. Raising the Fed funds rate is pressing the brake. By making borrowing more expensive, they discourage spending. Fewer people take out loans to buy cars or renovate their homes. Businesses think twice about borrowing money to expand. This slowdown in spending gives the supply of goods a chance to catch up with demand, and prices, inflation, begin to cool off. We all lived through a dramatic example of this starting in 2022. Inflation was raging, so the Fed began one of the fastest rate hiking cycles in history, and we all watched mortgage rates double in what felt like the blink of an eye. Now, what about the opposite scenario? What if the economy is sluggish, the car is barely moving, and people are losing their jobs? This is when the Fed hits the gas pedal. They lower the Fed funds rate. This makes money cheaper for banks. The banks, in turn, pass those savings on to you. They lower interest rates on loans to encourage you to borrow and spend. A lower mortgage rate might be the final push you need to buy a house. A cheap business loan encourages a company to build a new factory and hire more workers. By making money cheaper, the Fed stimulates economic activity, trying to achieve its other mandate: maximum employment. After the 2008 financial crisis, the Fed slammed the gas pedal to the floor, keeping the Fed funds rate near zero for years to try and get the economic engine running again. This led to a period of historically unbelievably low mortgage rates. So the Fed is essentially the driver of the economic car, using the Fed funds rate as the brake and the gas pedal to navigate the road between the dual dangers of high unemployment and high inflation. And your mortgage rate is directly impacted by how they choose to drive. But here's a crucial piece of nuance, and it's what separates a casual observer from someone who truly understands the market. Mortgage rates don't just react to what the Fed does. They react to what the market thinks the Fed is going to do. The people who set mortgage rates, the lenders, the investors on Wall Street, they don't wait for the official announcement. They are constantly analyzing economic data, listening to every word the Fed chair says, and trying to predict the future. If inflation numbers come out hot, the market might immediately think, the Fed is definitely going to raise rates at their next meeting. In response, mortgage rates might start climbing that very day, weeks before the Fed actually makes a move. The change gets priced in by the market ahead of time. Conversely, if unemployment numbers are suddenly terrible, the market might predict the Fed will have to cut rates to stimulate the economy, and mortgage rates could dip in anticipation. This is why you'll see mortgage rates fluctuate daily, even when the Fed hasn't done a thing. It's a giant ongoing game of prediction. So the Fed funds rate is the anchor for all short-term borrowing costs. It's the foundation. It sets the overall direction, the prevailing wind for interest rates across the entire economy. But it's not the whole story, especially for something as long-term as a 30-year mortgage. The Fed's rate is an overnight rate, a 24-hour loan. A mortgage is a 30-year loan. There's a big difference. And while the Fed's actions are a massive influence, there is another number, another financial instrument, that has an even more direct, more powerful, and more immediate correlation with 30-year fixed mortgage rates. It's a number that mortgage lenders watch like a hawk every single second of the trading day. This number is the true puppet master of the mortgage world. And understanding that number, the 10-year Treasury yield, is the next critical step in becoming an expert on where your mortgage rate truly comes from. So what exactly is this 10-year Treasury yield? And why does it hold the entire multi-trillion-dollar U.S. housing market in the palm of its hand? To understand this, we need to think like a giant bank for a moment. But first, we need to understand what a Treasury bond is. And it's actually incredibly simple. A U.S. Treasury bond is a loan. It's you lending money to the United States government. Imagine you give Uncle Sam $1,000. In return, he gives you a piece of paper that says, "Thank you for the loan. I promise to pay you back your $1,000 in exactly 10 years. And as a thank you for letting me borrow your money, I'll pay you a little bit of interest along the way." This promise is considered the safest financial asset on planet Earth. It is backed by the full faith and credit of the U.S. government, an entity that can, if it absolutely has to, literally print the money to pay you back. If the U.S. government ever fails to pay its debts, the value of your mortgage rate will be the absolute least of your worries. We'd be bartering for canned goods in a post-apocalyptic wasteland. So, for all practical purposes, it is a 100% risk-free investment. Now here's the critical part. That bond, that IOU from the government, can be bought and sold on the open market just like a share of Apple stock. Millions of these bonds are traded every single day by investors all over the world, pension funds, foreign governments, insurance companies, and big banks. And this is where the magic word comes in: yield. The yield is simply the effective rate of return an investor gets on that bond. And the single most important financial concept you need to grasp to understand mortgage rates is the relationship between a bond's price and its yield. They are on a permanent, unbreakable seesaw. When the price of a bond goes up, its yield goes down. When the price of a bond goes down, its yield goes up. They always move in opposite directions. Always. Let me make this crystal clear with an example. Let's say you buy a brand new 10-year Treasury bond directly from the government for $1,000. The government promises to pay you 4% interest per year, which is $40. So, for you, the original buyer, your yield is exactly 4%. Simple enough. But then a month later, news breaks. The economy is looking much weaker than anyone expected. People are getting scared. Big, powerful investors start pulling their money out of the risky stock market. They are terrified of losing their shirts. Where do they put that money? They rush to the safest place on earth, U.S. Treasury bonds. Suddenly, there is a massive surge in demand for the safety of your bond. Someone comes to you and says, "I'll buy that bond from you. I know you paid $1,000 for it, but I'm so desperate for safety, I'll pay you $1,100 for it right now." You agree and you just made a quick $100. But think about the new owner. They paid $1,100 for an asset that still only pays that same $40 in interest per year. Their effective rate of return, their yield, is no longer 4%. It's $40 divided by their $1,100 purchase price, which is now only about 3.6%. The price of the bond went up and as a result the yield went down. Now let's flip the scenario. Imagine the economy is absolutely booming. The stock market is setting new records every day. Everyone is optimistic and wants to take on more risk for a higher return. Nobody wants your boring bond that only pays 4%. Investors start selling their bonds to free up cash to buy more stocks. The market is flooded with sellers. To get rid of your bond, you might have to sell it at a discount. Someone agrees to buy it from you, but they'll only pay $900 for it. Think about that new buyer. They only paid $900, but they still get that same $40 in interest every year. Their effective return, their yield, is now $40 divided by their $900 cost, which is about 4.4%. The price of the bond went down and the yield went up. That is the seesaw. It's a constant tug-of-war between fear and greed, played out in the bond market. When fear is high, investors rush to the safety of bonds, pushing prices up and yields down. When greed is high, investors sell bonds to chase higher returns elsewhere, pushing prices down and yields up. This is happening every millisecond of the trading day, and that resulting number, the 10-year Treasury yield, is the number that mortgage lenders are watching like a hawk. So, here is the billion-dollar connection. Why does a mortgage lender care so much about the yield on a 10-year government loan? Because that yield represents their baseline, their alternative, their opportunity cost. A lender is in the business of lending money for a long period of time. A 30-year mortgage is a very long-term investment for them. Before they lend you $300,000 for 30 years, they have to ask themselves a very simple question. What else could I do with this money? Well, they could take that same $300,000 and lend it to the U.S. government by buying 10-year Treasury bonds. They could get a guaranteed risk-free return, currently dictated by the 10-year Treasury yield. So the 10-year Treasury yield becomes the absolute floor for mortgage rates. A lender would have to be certifiably insane to offer you a 30-year mortgage at a rate lower than what they could get, with zero risk from the U.S. government. It would be financial suicide. Therefore, the rate they offer you must, by definition, be the 10-year Treasury yield plus some extra amount on top. That extra amount is called the spread. The spread is the lender's compensation for taking on all the risks that don't exist with the Treasury bond. What are those risks? First, there's default risk. The U.S. government is never going to default. You, the borrower, might lose your job and stop making payments. That's a huge risk for the lender. Second, there's prepayment risk. This is a big one. If interest rates fall dramatically in 5 years, you're probably going to refinance your mortgage at a new, lower rate. When you do that, you pay off the lender's original high-interest loan early, and they lose out on all the future interest payments they were counting on. The U.S. government can't just decide to refinance its 10-year bond early. The lender is stuck with it for the full term. On top of those risks, the spread also covers the lender's administrative costs for servicing your loan, and of course, their profit margin. So the unbreakable formula is this. Your mortgage rate equals the 10-year Treasury yield plus the spread. The 10-year yield is the massive, powerful engine that drives the train. The spread is the fine-tuning, the throttle. While the spread can get a little wider or narrower depending on how lenders are feeling about the economy, the primary driver, the thing that causes the huge swings in mortgage rates, is the 10-year Treasury yield. Look at the evidence. In the spring of 2020, when the pandemic hit, the world was gripped by unprecedented fear and uncertainty. Investors dumped stocks and anything remotely risky and flooded into the safe haven of U.S. Treasury bonds. The demand was astronomical. Bond prices shot through the roof. And because of our seesaw, what happened to yields? They collapsed. The 10-year Treasury yield plummeted to an all-time low of around 0.5%. And what immediately followed? Mortgage rates cratered to historic lows, with millions of Americans refinancing or buying homes with rates in the 2s. Now, fast forward to 2022 and 2023. A new enemy appeared. runaway inflation. Inflation is the kryptonite of bonds. If you own a bond paying you a fixed 3% interest but inflation is running at 8%, you are losing 5% of your purchasing power every single year. You're getting poorer just by holding it. So what did investors do? They sold bonds. They sold them with a vengeance. The market was flooded with supply. Bond prices crashed. And what did our seesaw do? The 10-year Treasury yield skyrocketed, climbing from under 1% all the way up to nearly 5%. And what did mortgage rates do? They followed in perfect lockstep, soaring from the 2s and 3s all the way to the 7s and 8s, grinding the housing market to a halt. The correlation isn't a coincidence. It is a direct cause and effect. The 10-year Treasury yield is the North Star. If you want to know where mortgage rates are going tomorrow, next week, or next month, don't look at the evening news. Don't listen to a politician. Look up the 10-year Treasury yield. You can find it by searching the stock ticker symbol TNX. That number is the true, raw, unfiltered signal. So now you know the what. You know the puppet master is the 10-year Treasury yield. But that just raises the next, even more important question. If the 10-year Treasury pulls the strings on mortgage rates, what pulls the strings on the 10-year Treasury? What are the massive economic forces that cause this all-important yield to rise and fall? The answer lies in an epic, constant tug-of-war between the two most powerful forces in our entire economy, inflation and recession. And understanding their titanic battle for control is the final, crucial piece of the puzzle. Let's picture this battle as a colossal tug-of-war, happening in real time, every single second of every single day. On one end of the rope is inflation, on the other end, recession. And the little red flag tied to the center of that rope? That's the 10-year Treasury yield. Whichever way that flag moves determines the direction of your mortgage rate. First, let's meet the contender on the left. Inflation. Think of inflation as a slow, corrosive acid. It's the force that makes the dollar in your pocket worth a little less tomorrow than it is today. That coffee that cost you $4 last year now costs $4.50. That's inflation. Now, why does this matter to a bond investor, the person buying that 10-year Treasury note we talked about? Because a bond is essentially a loan with a fixed return. Imagine you buy a 10-year Treasury bond for $1,000 that pays you a 3% yield. You're locking in that 3% return for 10 whole years. But what if, over those 10 years, inflation averages 4%? Every year, the cost of everything is going up by 4%, but your investment is only growing by 3%. You're actually losing purchasing power. You're running on a financial treadmill, and someone is slowly speeding it up until you're moving backwards. For a bond investor, whose entire game is about predictable, fixed returns, inflation is the ultimate villain. It's pure poison. So, when investors even smell inflation coming, when they see signs that the economy is overheating, that people are spending too much money too quickly, and that prices are about to surge, what do? They refuse to buy bonds at the current yield. They say, no way am I locking in a 3% return if I think inflation is going to be 4% or 5%. You need to pay me more to compensate for that risk. This creates a massive sell-off of existing bonds. Investors dump what they have, demanding a better deal. And just like we learned, when the price of bonds goes down, the yield goes up. The market is forced to offer a higher interest rate on new bonds to attract buyers. So, the fear of future inflation, or the reality of current inflation, gives a mighty pull on the rope. The red flag, our 10-year Treasury yield, gets dragged upwards. And right behind it, mortgage rates get dragged up too. A strong jobs report, suggesting everyone has money to spend? That's inflation's team pulling on the rope. The government announcing massive new spending programs? Inflation pulls. Supply chain disruptions making goods more expensive? Inflation digs in its heels and pulls even harder. Any news that suggests the economy is running hot and prices will rise causes the 10-year Treasury yield to climb, and your potential mortgage payment right along with it. Now let's look at the other giant at the opposite end of the rope, recession. If inflation is a slow, corrosive acid, recession is a sudden, terrifying storm. It's the fear of economic collapse. It's when companies start laying people off, businesses shut down, and the entire economic engine begins to sputter and stall. So how does this force affect the 10-year Treasury yield? In the exact opposite way. During times of fear, uncertainty, and panic, what do investors do? They panic sell risky assets. They dump their stocks. They get out of volatile investments. They are no longer seeking high returns. They are seeking one thing and one thing only: safety. They are looking for a guaranteed place to hide their money where they know it will be there when the storm passes. And in the entire global financial system, there is no safer place to park your money than in a U.S. Treasury bond. It is backed by the full faith and credit of the United States government, the most powerful economic entity on planet Earth. It is considered the ultimate safe haven asset. So when fears of a recession begin to mount, a massive wave of money comes rushing out of the stock market and other risky places, and it all tries to cram itself into the safe harbor of U.S. bonds. This creates a buying frenzy. Everyone wants to buy bonds. And what happens when demand for something skyrockets? The price goes up. And as we now know inside and out, when the price of bonds goes up, the yield goes down. The overwhelming demand for safety pushes bond prices to the moon, which in turn crushes the yield. The giant recession gives a colossal heave on the rope, dragging the red flag, the 10-year Treasury yield, down into the mud. And mortgage rates tethered to that flag fall right down with it. A weak jobs report, suggesting the economy is slowing? That's recession's team pulling on the rope. A major bank failure sending shockwaves through the system? Recession pulls. A global conflict that spooks the markets? Recession digs in and pulls with all its might. Any news that suggests economic weakness or creates widespread fear causes investors to flee to the safety of bonds, pushing the 10-year yield down and giving potential homebuyers a shot at a lower mortgage rate. So this is the eternal battle. Every single day, these two forces are at war. The market is a battlefield, and every piece of economic data is another shot fired. The Consumer Price Index, which measures inflation, that's a cannonball from inflation's side. The Gross Domestic Product, or GDP, which measures economic growth. Its result determines which side gains ground. A speech from the head of the Federal Reserve can be a strategic maneuver that strengthens one giant and weakens the other. This is why the 10-year Treasury yield is so volatile. It's not moving randomly. It is the real-time, visible outcome of this constant, epic struggle. It is the scoreboard of the fight between the desire for growth, which risks inflation, and the fear of collapse, which brings recession. When you see a financial news headline that says, "Markets soar on positive economic outlook," what that really means is that the giant of inflation just won a battle, and the 10-year yield is likely rising. When you see a headline that says, "Stocks tumble on recession fears," that means the giant of recession just landed a heavy blow, and the 10-year yield is likely falling. And you, the person trying to buy a home, are standing right in the middle of this battlefield. The interest rate you are quoted for your mortgage is a direct reflection of which one of these two giants is winning the war on that particular day, that particular hour, even that particular minute. The rate you're offered isn't just a number a banker picks out of the air. It is the end result of this titanic, global conflict between the fear of money losing its value and the fear of the entire economic system grinding to a halt. But there's one more combatant we haven't discussed. A referee of sorts who can step onto the battlefield and change the rules of the game entirely. This entity has the power to make one giant stronger and the other weaker with a single sentence. They are the most powerful player in this entire saga, and their actions can override everything else we've just discussed. I'm talking, of course, about the Federal Reserve. And understanding their role is the next critical step. So let's pull back the curtain on this institution. The Federal Reserve, or the Fed, isn't some shadowy cabal, but it is the central bank of the United States. And it operates with what's called a dual mandate, a mission given to it by Congress with two primary goals: to achieve maximum employment and to maintain stable prices. Think of it like a tightrope walker. On one side is a booming job market. On the other is keeping the cost of everything you buy from spiraling out of control. That's the balance they have to strike every single day. Their entire existence is a high-stakes balancing act. Now, to perform this act, the Fed has a primary tool. It's the one you hear about on the news all the time. It's called the federal funds rate. This sounds complicated, but the concept is surprisingly simple. It is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. It's the base-level wholesale cost of money. Imagine the entire financial system is a giant plumbing network. The federal funds rate is the pressure setting at the main water plant. The Fed doesn't control the faucet in your kitchen. That's your mortgage rate. But by increasing or decreasing the pressure at the source, they have an enormous influence on the flow and cost of water everywhere down the line. And this is the single most important misconception to clear up. The Federal Reserve does not directly set mortgage rates. When you hear the Fed raised rates by a quarter point, they are not talking about your 30-year fixed mortgage. They are talking about that overnight bank-to-bank lending rate. Mortgages are long-term loans, 30 years in most cases. The Fed funds rate is an overnight rate. They are fundamentally different products. So how does one affect the other? It's a ripple effect. When the Fed raises the federal funds rate, it makes it more expensive for banks to do business. Their own borrowing costs go up. And like any business, they pass that increased cost down the line. The cost of car loans, credit cards, business loans, it all starts to creep up. This is the Fed intentionally tapping the brakes on the economy. They do this when they see their other mandate, stable prices, being threatened by inflation. When the economy is running too hot and prices are rising too fast, the Fed raises rates to cool things down, to make borrowing and spending less attractive, and to bring inflation back under control. We saw the most brutal example of this in the early 1980s. Inflation was a monster, devouring people's savings at over 13% a year. The Fed chairman at the time, a towering cigar-smoking man named Paul Volcker, decided to do the unthinkable. He raised the federal funds rate to an eye-watering 20%. He deliberately plunged the country into a deep, painful recession. It was economic shock therapy, and it was brutal, but it worked. He broke the back of inflation, and during that time, the average 30-year fixed mortgage rate peaked at over 18%. 18%. That is the raw brute force power of the Federal Reserve. Conversely, when the economy is weak or in a recession, the Fed does the opposite. They hit the accelerator. They cut the federal funds rate, making it cheaper for banks to borrow. This encourages them to lend more, which encourages businesses to expand and people to spend, stimulating economic growth. After the 2008 financial crisis, the Fed slammed the rate down to effectively zero and kept it there for years to try and breathe life back into a dying economy. They did the same thing during the COVID-19 pandemic. But that's not their only tool. What happens when you've already cut the federal funds rate to zero, but the economy still needs help? You can't go lower. This is when the Fed unleashes its far more controversial and powerful weapon: quantitative easing, or QE. If the Fed funds rate is like adjusting the pressure at the water plant, QE is like the Fed driving a fleet of water tankers into the city and just opening the spigots directly into the system. It's a massive direct injection of money. Here's how it works, and this is where the connection to your mortgage becomes crystal clear. During QE, the Fed creates new money digitally and uses it to buy financial assets on the open market. And what assets do they buy? Primarily U.S. Treasury bonds and mortgage-backed securities, the very same MBS we talked about in the last part. Think about that. The most powerful financial institution on earth steps into the market and starts buying up trillions of dollars worth of the bonds that are made of bundled-up mortgages. What happens when a massive buyer with unlimited funds enters any market? The demand for that product skyrockets. And when demand for a bond goes up, its price goes up. And this is the crucial link: when a bond's price goes up, its yield, its interest rate goes down. So by buying MBS directly, the Fed isn't just influencing mortgage rates indirectly through the plumbing of the financial system. It is actively, directly, and powerfully forcing long-term mortgage rates down. This was a primary feature of the economic recovery after 2008 and during the pandemic. The Fed's goal was to make housing so affordable from an interest rate perspective that it would stimulate the construction industry and the housing market, creating jobs and a wealth effect that would ripple through the economy. Of course, what goes up must come down. The opposite of QE is quantitative tightening, or QT. This is when the Fed stops buying those bonds and starts letting them mature and roll off its balance sheet, or even start selling them. It's like they are taking their thumb off the scale. They are no longer an active buyer, so demand for MBS falls. The price of those bonds falls. And when the price falls, the yield, the interest rate, goes up. We've been in a period of QT recently, and it is a significant reason why mortgage rates have climbed so dramatically. The largest, most powerful buyer has left the building. But the Fed's power isn't just in these mechanical actions. Perhaps their most potent tool is something much simpler: their words. The financial markets are forward-looking. They don't just react to what the Fed did today, they react to what they think the Fed is going to do over the next 6 to 12 months. This is why every speech by the Fed chair, every set of meeting minutes, every press conference is scrutinized down to the individual comma. This is called forward guidance. When the Fed signals its intentions, the market reacts instantly. If the Fed chair even hints that they're concerned about inflation and might need to raise rates at some point in the future, you can watch the 10-year Treasury yield, our old friend, jump in real time. Lenders see that and immediately start repricing their mortgages higher, long before the Fed has actually done anything. The expectation of a rate hike can have the same effect as a rate hike itself. The Fed knows this. They use their language very carefully to guide the market, to prevent shocks, and to get the market to do their work for them. They are, in essence, the ultimate financial influencer. Their words can move trillions of dollars. So, the Federal Reserve is the grand conductor of the economy. They don't set your specific mortgage rate, but they set the entire tone. They control the fundamental cost of money through the Fed funds rate. They can directly manipulate the long-term rates through the massive gravitational pull of QE and QT, and they can steer the entire ship with their words alone, using forward guidance to manage market expectations. They are reacting to the economy's health, constantly trying to keep that tightrope walker balance between jobs and inflation. Which brings us to the final crucial question. If the Fed is the doctor, what's on the patient's chart? What are the vital signs of the economy they are obsessively monitoring to make these monumental decisions? Understanding what they look at is the key to predicting what they might do next. And that's exactly where we're going. The first thing they look at, the number that has kept them up at night for the past few years, is the patient's temperature. They're checking for a fever. And in economics, that fever is called inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. Think of it this way. The dollar in your pocket today will buy you less tomorrow. When that process gets out of control, it's like a raging fever that can destabilize the entire system. The Federal Reserve has a target, a healthy temperature for the economy, which is 2% inflation per year. A little bit is considered healthy, like a sign of a warm, growing body. But when it spikes to 7, 8, or even 9%, the alarm bells don't just ring, they scream. To measure this fever, the Fed looks at two primary thermometers. The first one is the one you always hear about in the news, the Consumer Price Index, or the CPI. Imagine a giant shopping cart that the government fills up every month with a representative sample of goods and services that the average urban consumer buys. We're talking about everything from a gallon of milk and a loaf of bread to a month's rent, a new t-shirt, and a gallon of gasoline. They track the total cost of this cart over time. If the cart cost $100 last year and it costs $105 this year, the CPI inflation is 5%. It's the people's inflation metric. It's what you and I feel directly in our wallets. But while the Fed pays close attention to the CPI, it's not actually their favorite thermometer. Their preferred gauge is a bit more obscure, but far more important for their decision-making. It's called the Personal Consumption Expenditures Price Index, or the PCE. Think of the PCE as the smarter, more sophisticated older sibling of the CPI. Why do they prefer it? For two main reasons. First, it's broader. It includes a wider range of expenditures, including things paid for on our behalf, like medical care paid by an employer's insurance. Second, and this is the crucial part, it accounts for substitution. The CPI uses a fixed basket of goods. It assumes you keep buying the same amount of steak even when the price skyrockets. The PCE is smarter. It recognizes that when steak gets too expensive, real people switch to chicken. It adjusts for our changing behavior, making it a more accurate reflection of our actual spending habits. So when you hear the Fed chair speak, listen closely for the letters PC. That's the number they truly care about. That's the fever they are sworn to break. Once they've taken the patient's temperature, the Fed immediately checks the heartbeat. The strength and rhythm of the economy's heart is the labor market. A strong, steady heartbeat means people have jobs, they're earning money, and they're spending it. The most famous indicator here is, of course, the unemployment rate. This is the percentage of the labor force that is jobless and actively looking for work. A low unemployment rate, say below 4%, is generally seen as a sign of a very healthy, robust economy. It means businesses are confident, they're expanding, and they need people. But here is where the Fed's job gets incredibly tricky. This is a classic case of too much of a good thing. If the unemployment rate gets too low for too long, it can actually be a problem. Why? Because when every company is desperately trying to hire from a tiny pool of available workers, they have to compete. And how do they compete? By offering higher and higher wages. Now, a bigger paycheck sounds great to all of us. But if wages are rising too quickly across the entire economy, businesses have to pass those extra labor costs onto consumers in the form of higher prices. This creates something economists call a wage price spiral. Wages go up, so prices go up, so workers demand even higher wages to keep up, which pushes prices up even further. It's a vicious cycle that pours gasoline on the fire of inflation. So the Fed is in a delicate balancing act. They want a strong labor market, but not one that's so hot it overheats and causes an inflationary spiral. It's like being a personal trainer for the economy. You want to push it to be strong, but not so hard that it has a heart attack. To get a more frequent, real-time reading of this heartbeat, they obsess over the monthly jobs report, specifically a number called non-farm payrolls. This number tells us how many jobs were created or lost in the previous month, across basically every sector except for farming. The release of this report on the first Friday of every month is a massive event on Wall Street. It's the economy's monthly report card. A huge number of new jobs? That's a sign of a booming economy, which might make the Fed worry about overheating. A weak number, or even job losses, that's a sign the economy is slowing down, maybe even heading for a recession. Every single data point, from wage growth within that report to the labor force participation rate, is scrutinized under a microscope. It tells the Fed not just how the patient is doing today, but the direction it's heading. Finally, after checking the temperature and the heartbeat, the Fed takes a step back to assess the patient's overall strength and vitality. The single best measure for this is the gross domestic product, or GDP. GDP is the big one. It's the total monetary value of all the finished goods and services produced within a country's borders in a specific time period. It's the ultimate scoreboard for the economy. When you hear that the US economy is a $27 trillion economy, that number is its annual GDP. The number itself is less important than its rate of change. Is the economy growing or shrinking? A positive GDP growth rate means the economic pie is getting bigger. Companies are producing more, people are earning more, and the standard of living is generally improving. This is what we want. A negative GDP growth rate means the pie is shrinking. The economy is in reverse. If that happens for 2 consecutive quarters, it's the technical definition of a recession. The Fed's mandate is a tightrope walk between its 2 primary goals: stable prices, meaning low inflation and maximum employment. GDP is the context for that tightrope walk. When the Fed raises interest rates to fight the fever of inflation, they are deliberately giving the economy a medicine that slows it down. It makes borrowing more expensive, which cools off spending and investment. This slower activity will, in turn, reduce the upward pressure on prices. But if they give the patient too much medicine, if they raise rates too high or too fast, they can slow the economy down so much that they accidentally tip it into a recession. They can kill GDP growth and cause millions of people to lose their jobs. This is the nightmare scenario. It's what economists call a hard landing. The Fed's ultimate goal, their holy grail, is the soft landing. A situation where they successfully raise rates just enough to bring inflation back down to their 2% target without causing a major economic downturn. It's like trying to land a massive jumbo jet on a tiny aircraft carrier in the middle of a storm at night. Every piece of data, every inflation reading, every jobs report, every GDP print is another gust of wind or another wave that the pilot has to react to in real time. These are not abstract numbers in a textbook. They are the vital signs that determine the financial health of the nation and, ultimately, the interest rate on your next mortgage. So how do these vital signs, these economic reports on inflation and jobs, actually travel from a government spreadsheet in Washington, D.C., and physically change the number on your mortgage offer? It isn't magic. It's a machine. A massive, global, multi-trillion-dollar machine that most people never see, but it's running 24/7. And the primary engine of this machine is the bond market. Now, stay with me because this is where you gain an advantage over 99% of other homebuyers. A bond at its core is just a fancy IOU. When you buy a bond, you are lending money to an entity, a corporation or a government, and in return they promise to pay you back with interest over a set period. The safest, most influential IOU on planet Earth is a U.S. Treasury bond. You are lending money to the United States government, an entity that has never ever defaulted on its debt. There are many types of treasury bonds, but the one you need to watch, the North Star for all long-term debt, is the 10-year treasury note. Its interest rate, known as its yield, is like the master rhythm that the entire American financial system dances to. When the yield on the 10-year treasury goes up, mortgage rates almost always follow. When it goes down, mortgage rates tend to fall. They are like 2 dancers moving in near-perfect sync. But what makes this treasury yield go up or down? It comes down to a simple but powerful inverse relationship: the relationship between a bond's price and its yield. Think of it like a seesaw. When the price of the bond goes up on one side, the yield, or the interest rate it pays out, goes down on the other. And vice versa. When the price goes down, the yield goes up. Here's why. Imagine there's a 10-year Treasury bond that pays $100 in interest each year. If you buy that bond for its face value of, say, $10,000, your yield is a simple 1%. But what if there's a huge demand for that bond? What if investors all over the world, scared of a recession or a stock market crash, are desperately seeking the safety of U.S. government debt? A bidding war starts. They're not buying it for $10,000 anymore. Maybe someone pays $10,500 for it. They still only get that same $100 in interest per year, but because they paid more upfront, their effective return, their yield, is now lower. The price went up, the yield went down. Conversely, if the economy is booming and inflation is high, investors might think, why would I lock my money up in a safe bond for a 1% return when I could make more elsewhere? They start selling their bonds. The supply of bonds for sale increases and the price drops. Maybe now you can buy that same bond for $9,500. You still get the $100 a year in interest, but because you paid less for it, your yield is now higher. The price went down, the yield went up. So when you see a news report that the economy is stronger than expected, or that inflation is stubbornly high, what's really happening is that millions of investors are simultaneously thinking, the Fed is going to have to keep fighting inflation, which means better returns will be available elsewhere soon. I'm selling my bonds. That selling pressure pushes bond prices down, which, like the other end of the seesaw, pushes yields, and by extension mortgage rates, up. This brings us to the crucial link. Why does the yield on a government IOU have anything to do with your home loan? Because lenders and investors view a 30-year mortgage and a 10-year treasury as similar types of investments. Both are long-term, relatively stable streams of income. So an investor who is deciding where to put their money looks at the ultra-safe, risk-free return they can get from the 10-year treasury and uses that as their starting point. They say to themselves, okay, I can get, say, 4% from the US government guaranteed. A mortgage is a little bit riskier. The borrower could default, they could pay it off early. So to convince me to buy that mortgage instead of the treasury, I need a better return. I need the 4% I can get from the treasury, plus a little extra for taking on that risk. That plus a little extra is called the spread, and it is the direct bridge between the government bond market and your mortgage rate. Your rate is fundamentally the 10-year treasury yield plus a risk premium. But it gets even more direct. There is a second, even more powerful market working in the background. This is the part they don't teach you in school. Lenders don't just hold on to your mortgage for 30 years. That would be incredibly inefficient. Instead, they package it. Imagine a lender takes your mortgage, my mortgage, and thousands of others from across the country. They put them all into a giant financial blender. They mix them all up, different loan sizes, different credit scores, different locations, and create one massive diversified investment product. This financial smoothie is called a mortgage-backed security, or MBS. And then they sell slices of this MBS smoothie to big institutional investors, pension funds managing your retirement, insurance companies, and even foreign governments. This creates a constant flow of new cash back to the original lenders, which they can then use to issue new mortgages to people like you. It's the circle of life for the housing market. And just like any other market, the MBS market runs on supply and demand. When investors are feeling confident and have a big appetite for these mortgage-backed securities, they bid up the prices. And remember our seesaw rule? When the price of the MBS goes up, its yield goes down. A lower yield on the MBS means the lender doesn't need to charge as much interest on the original mortgages to make the smoothie appealing to investors. The result? Lenders can offer you a lower interest rate. But what happens when those economic reports show inflation is rising or a recession looks likely? Investors get scared. Their appetite for MBS dries up. They worry that homeowners might lose their jobs in default. Demand plummets, the price of MBS falls, and its yield shoots up. To create a new MBS that investors will actually buy in this fearful environment, the lender has to pack it with mortgages that have higher interest rates. The result? The rate they offer you goes up. Now, for the last decade, there has been one customer in this MBS market more important than all the others combined: the Federal Reserve itself. During the 2008 financial crisis and again in 2020, the Fed stepped in to stabilize the economy using a tool called quantitative easing. They essentially walked into the MBS market with an unlimited wallet and became the biggest buyer in the world, purchasing trillions of dollars worth of these securities. This colossal artificial demand sent MBS prices into the stratosphere, which in turn pushed their yields, and therefore mortgage rates, to historic rock-bottom lows. It was a direct brute force injection of adrenaline into the housing market. But now the Fed is doing the opposite. It's called quantitative tightening. They've not only stopped buying, but they are slowly letting their massive holdings of MBS fade away. The biggest customer has left the building. This reduces demand, which pushes MBS prices down and forces mortgage rates up. So you see the chain of command. The economic data influences investor fear and greed. That sentiment drives the price of the 10-year Treasury, which sets the baseline for all long-term rates. At the same time, that sentiment directly impacts the supply and demand in the massive, hidden market for mortgage-backed securities, which adds the final layer to the rate you are quoted. It's a vast, interconnected ecosystem, a global financial weather system that is constantly shifting. But every single one of these factors we've discussed, the Fed, inflation, jobs, the global bond market, they are all external. They are the tide. They are the macro environment that every single borrower faces. But this entire global machine is just one side of the equation. Because the final and arguably most powerful factor that will determine your specific interest rate is you. That's right. After all the talk of global markets, federal policies, and economic indicators, the single most influential variable in the interest rate you are offered is your own financial story. Think of it this way. The Federal Reserve and the bond market set the baseline temperature of the water. But your personal financial profile is what determines whether you get to swim in the comfortable, heated section of the pool, or you're stuck in the icy deep end. Lenders are in the business of managing risk. And when they look at you, they're not just seeing a person who wants a house. They are seeing a collection of data points that tell a story that predicts one crucial thing: the likelihood that you will pay back hundreds of thousands of dollars on time every single month for decades. So, how do they write this story about you? They look at three core pillars of your financial life: your past, your present, and your future commitment. First, let's talk about your past. This is captured by the most famous and often most feared number in personal finance: your credit score. Your credit score is not just a number. It's a summary of your entire history as a borrower. It's a financial trust score. Have you borrowed money before? Did you pay it back on time? Every time? How much debt are you currently juggling? How long have you been managing credit successfully? Lenders like FICO and VantageScore boil all of this history down into a single three-digit number that screams either reliable or risky. Think about it from the lender's perspective. If a friend asks to borrow $1,000, one of the first things you consider is their track record. Have they borrowed money from you before and paid it back? Or are they the friend who always forgets their wallet? Your credit report is that detailed track record for lenders. A high score, typically anything above 740, tells a lender that you are a prime borrower. You have a long history of making payments on time. You don't max out your credit cards. You are, in their eyes, a safe bet. And safe bets are rewarded with the lowest interest rates. Conversely, a lower score, say below 640, sends up red flags. It might mean you've had late payments, defaults, or a bankruptcy in your past. It tells the lender that your financial story has some chapters with unhappy endings. To them, this means there's a higher statistical chance you might not pay them back. To compensate for that increased risk, they charge you a higher interest rate. It's their financial insurance policy against your spotty track record. A single percentage point difference born from your credit score can cost you tens of thousands, even hundreds of thousands of dollars over the life of a 30-year loan. Your past isn't just history, it's money. Next, the lender examines your present. Your past reliability is crucial, but they also need to know: can you handle this massive new debt right now? This is where your debt-to-income ratio, or DTI, comes into play. It's one of the most critical and yet least understood metrics by homebuyers. DTI is a simple but brutal calculation. The lender adds up all of your monthly debt payments, your car loan, student loans, credit card minimums, and yes, your proposed new mortgage payment, including taxes and insurance. Then they divide that total by your gross monthly income before taxes. The resulting percentage is your DTI. It's a snapshot of your current financial stress level. Imagine you're carrying a heavy backpack. That's your existing debt. A lender wants to add a massive boulder to it: your mortgage. Your DTI tells them if you have the strength to carry both without collapsing. If your DTI is low, say under 36%, it shows the lender that you have plenty of financial breathing room. A large portion of your income is free and clear, making it very likely you can comfortably handle the new mortgage payment, even if unexpected expenses pop up. You're a low risk. But if your DTI is high, creeping up towards 43% or even 50%, the lender gets nervous. This tells them you are stretched thin. Almost half of your income is already spoken for before you even buy groceries, pay for gas, or save for retirement. To a lender, a high DTI borrower is living on the edge. A single unexpected event, a job loss, a medical bill, a major car repair, could be enough to push them over and cause them to miss a mortgage payment. That's a massive risk. So, to compensate, they will either charge you a significantly higher interest rate or, in many cases, deny the loan altogether. Your present-day financial breathing room is a direct dial on your interest rate. Finally, after looking at your past and your present, the lender looks to the future. Specifically, your future commitment to this property. This is measured by your down payment, which directly creates your loan-to-value ratio, or LTV. The loan-to-value is exactly what it sounds like. The size of the loan compared to the value of the house. If you buy a $400,000 house and put down $80,000, you're borrowing $320,000. Your LTV is 80%. That $80,000 down payment isn't just a pile of cash. To a lender, it's a powerful psychological and financial anchor. It's your skin in the game. When you put down a substantial amount of your own money, two things happen. First, you are less of a risk to the lender. In a worst-case scenario where you default and they have to foreclose, the house price would have to fall by a full 20% before the bank starts losing money. Your down payment is their safety cushion. The bigger the cushion, the safer they feel, and the lower the rate they'll offer you. This is also why lenders require private mortgage insurance, or PMI, on loans with less than a 20% down payment. PMI is an insurance policy that you pay for, but it protects the lender in case you default. It's the price you pay for not providing them with that 20% safety cushion. Second, and just as important, a large down payment signals a deep personal commitment. People are far less likely to walk away from a home they have a significant financial stake in. If you've scrimped and saved for years to put $100,000 into your home, you will fight tooth and nail to make those payments during tough times. You have too much to lose. Someone with a 0 or 3% down payment has far less of a financial tether to the property. In a housing downturn, they could be underwater on their mortgage almost instantly, making it much easier psychologically to walk away. Your down payment is a pledge. The more you pledge, the more the lender trusts your commitment, and the better your rate will be. These three factors, your credit score, your DTI, and your down payment, form the holy trinity of your personal mortgage application. But they're not the only personal factors. The very type of loan you choose matters. A 30-year fixed-rate mortgage is the gold standard, the most predictable and thus often the most favorably priced for a qualified borrower. An adjustable-rate mortgage, or ARM, might start with a lower teaser rate, but it carries the risk of future rate hikes, a risk that lenders factor into their pricing. Government-backed loans like FHA or VA loans have different qualification criteria and risk pools, which also influences their rate structures. Even the type of property you're buying, a standard single-family home versus a condominium or a multi-unit investment property, changes the risk equation for the lender and, therefore, the rate they will offer you. Every single one of these personal details is a lever that can be pulled to either raise or lower the interest rate you are quoted. It's a complex, interwoven tapestry. The global economy sets the stage, but your personal financial discipline writes the script. Your rate isn't a number that happens to you. It's a number you actively help create, for better or for worse, through years of financial decisions. It is the final, personalized price tag on the biggest purchase of your life, calculated by combining the vast, impersonal forces of the market with the intimate details of your own financial story. So, how do you take control of that story? How do you step into this vast, complex arena where global finance meets your front porch, and emerge with a rate that doesn't just let you buy a house, but lets you build a future? You do it by focusing relentlessly on the parts of the equation you can actually control. The market is a powerful, unpredictable ocean. You can't command the tides, but you can build a stronger ship. Your first and most powerful tool is your credit score. This isn't just a 3-digit number. It's the distilled essence of your financial reputation. Lenders see it as a direct measure of your reliability. A score of 760 or higher tells them you are a prime borrower, a low-risk investment. A score below 640 signals caution, flashing a warning light that demands a higher interest rate to compensate for the perceived risk. The difference isn't trivial. A borrower with excellent credit might get a rate a full percentage point, or even more, below someone with fair or poor credit. On a $400,000 loan, that single percentage point can mean over $250 a month. Every single month. For 30 years. That's $90,000. The price of a luxury car, a child's college education, or a secure retirement, all decided by that one number. So you guard it. You cultivate it. You pay every bill on time without exception. You keep your credit card balances low, ideally below 30% of your limit. You don't open a bunch of new accounts right before you apply for a mortgage. And you check your credit report religiously, hunting down and disputing any errors that could be unfairly dragging you down. Your credit score is your financial armor. The stronger it is, the less the market's arrows can hurt you. Next, you build a fortress of cash. This is your down payment and your reserves. The old 20% down rule isn't just an arbitrary benchmark. It's a critical threshold. When you put 20% down, you eliminate the need for private mortgage insurance or PMI, which is an extra monthly fee that protects the lender, not you. But more than that, a substantial down payment is a powerful signal of financial stability. It lowers the loan-to-value ratio, or LTV, which is a key metric for lenders. A lower LTV means less risk for them, and less risk translates directly into a better interest rate for you. Lenders see a large down payment and think, this person has skin in the game. They are disciplined. They are less likely to default. So you save aggressively. You treat your down payment fund as a non-negotiable expense, like rent or electricity. Every dollar you add to that pile is a dollar that works to lower your future interest rate and build instant equity in your home. Then you must master your cash flow, encapsulated in your debt-to-income ratio, or DTI. This is the financial world's version of a stress test. It's a simple calculation. All your monthly debt payments, student loans, car payments, credit cards, divided by your gross monthly income. A high DTI, say above 43%, tells a lender that you're stretched thin. Your financial breathing room is limited. A small emergency, a job loss, could push you over the edge. To a lender, that's a massive red flag. A lower DTI, ideally below 36%, shows them you have a comfortable buffer. You can handle the new mortgage payment and still have room to maneuver. So before you even think about house hunting, you go to war with your existing debt. You attack the high-interest credit cards first. You consider consolidating loans. You avoid taking on any new debt, like financing a car or furniture. Lowering your DTI is like clearing the runway before takeoff. It ensures a smoother, safer, and ultimately cheaper journey into homeownership. Those are your levers: credit, capital, and cash flow. They form the foundation of your personal financial story. But what about the things you can't control? The Federal Reserve's meetings, the chaotic dance of the bond market, the specter of inflation? You can't control them, but you can understand them. And understanding is a form of power. When you hear on the news that the Fed is raising the federal funds rate to combat inflation, you'll no longer hear abstract financial jargon. You'll understand that the cost of borrowing for banks is going up, and that cost will inevitably trickle down, putting upward pressure on your potential mortgage rate. When you see reports that the 10-year Treasury yield is rising, you won't just see a number on a screen. You'll recognize it as the primary benchmark for fixed-rate mortgages, a direct indicator of where rates are headed. You'll learn to watch these indicators not with anxiety, but with awareness. This knowledge transforms you from a passive victim of the market into an informed strategist. You can't time the market perfectly, no one can. Waiting for the absolute bottom of a rate cycle is a fool's errand that could cause you to miss out on the right house. But you can make an educated decision. You can understand the environment you're operating in. You can choose to lock in a rate when indicators look volatile, or you can decide to float your rate if you have good reason to believe a downturn is imminent. You learn to sail the economic seas, adjusting your strategy based on the winds and the currents you now understand. And this brings us to the final crucial factor, the one that ties everything together: competition. You have done the work. You've polished your credit, saved your down payment, and streamlined your debts. You understand the market forces at play. Now, you must make the lenders compete for the right to give you their money. Never ever take the first offer you receive. Getting a mortgage is not like buying a product with a fixed price tag. It's a negotiation. The rate you are offered from one bank is not the rate, it is a rate. Another lender with a different financial position, a different appetite for risk, or a different set of overhead costs might offer you something significantly better. You should get quotes from at least 3 to 5 different lenders. Talk to big national banks, local credit unions, and independent mortgage brokers. A mortgage broker can be an invaluable ally, as they have access to wholesale rates from dozens of lenders and can shop on your behalf to find the absolute best deal for your specific situation. The difference can be astounding. A quarter of a percentage point, 0.25%, might sound insignificant, But on that same $400,000 loan, it saves you over $25,000 in interest over the life of the loan. For the effort of a few extra phone calls and applications, you can save a fortune. You must force the market to work for you. You are the prize. You are the low-risk, well-prepared borrower they all want on their books. Ultimately, the interest rate on your mortgage is the final chapter in a long and complex story. It's a story written by global economic trends, national monetary policy, and the quiet, consistent financial habits you've built over years. It's a reflection of the world, and it's a reflection of you. Understanding these factors strips away the fear and the mystery. It replaces anxiety with agency. You are no longer just a homebuyer, subject to the whims of an opaque financial system. You are an informed participant, a strategist, an architect of your own financial destiny. You know what the numbers mean, you know which levers to pull, and you know how to position yourself to achieve the best possible outcome. The journey to homeownership is one of the most significant you will ever take, and the interest rate you secure is the price of that ticket. But now you know how that price is set. And with that knowledge, you don't just have to pay the price. You have the power to help write it.